Hey folks, we talked about the journal entries for costing, job order costing. We have talked about how the overhead T account works. So now the final video in this little three-part series is computing cost of goods manufactured and cost of goods sold. So if you'll recall, we made some basic journal entries for job order costing. We ended up with some under applied overhead, I believe, right there. And now we're going to take all of the journal entries and get them all the way into a final income statement. Okay, so when I look in a normal textbook and I see the cost of goods manufactured formal statement, it terrifies me. I'll admit it. It's like it doesn't make any sense. So what I've done is I've broken it down into three things that make sense to me. So, if you remember the basic compute, the periodic system cost of goods sold, you start with beginning inventory, you add net purchases, that equals goods available for sale, you subtract the ending inventory, and that equals the cost of goods sold. Okay, we're going to take that basic formula because it's easy to remember, and we're going to apply it to the inventory accounts for raw materials, work in process, finished goods. We're going to make a couple of tweaks to them, but not a whole lot. Okay, so we're going to start with the beginning inventory of raw materials, new company, zero beginning inventory. We do purchase our raw materials, so we're going to add the net purchases of raw materials. From our journal entries, we saw it was $30,000. 0 plus $30,000 is going to give me the goods available. If we run a T account for raw materials from the journal entries above, we'll see that we have $1,000 left. So that gives us the cost of raw materials that we used in production. Now, raw materials includes both direct and indirect materials. Because you'll notice that when we made our journal entry up here and we took things out of raw materials, we took out both direct and indirect. Okay, so that's an important concept. So if we take out the indirect materials because they're part of overhead, that gives us just the direct materials used in production. Okay, this number right here is going to go up here for our work in process. So we have our beginning inventory for work in process, which is 0. I have my 0 in the wrong spot, so let's fix that. Now we don't buy our work in process, we make it. And remember, we have 3 product costs that are added to work in process. So it's direct materials used, our $25,000 we just computed, our actual direct labor that you get from the journal entries, and our applied overhead. That's our credit to our overhead account, and it got put into work in process. So these are our 3 debits to our work in process account. So total manufacturing costs are 103. If we add it to our beginning inventory, we get our goods available for work in process. We subtract our ending inventory of work in process, which is what we put in. Right here is our work in process. What we put in minus what we took out leaves us a $3,000 ending balance. So cost of goods manufactured of $100,000 is what we end up with. Isn't that a lot easier to read than that big formal statement? I think so. Okay, so we're going to take this $100,000 and we're going to put it right here as our cost of goods manufactured because that's how we get finished goods. So we start with the beginning of 0. We add what we made, the cost of the goods we manufactured. That equals our goods available for finished goods. Subtract our ending inventory of finished goods. If you need to do a T account for finished goods, go for it. That gives us an unadjusted cost of goods sold number. Okay, unadjusted is the key word here. Remember we had under applied overhead? So if we look at that overhead T account again, and we see a debit balance of $2,500, we need to close that to cost of goods sold. So to close the account, I want a zero balance in my overhead account. So to get that, I need to credit overhead and debit cost of goods sold. So you need to remember from your beginning principles that cost of goods sold has a normal debit balance. So if I debit $2,500 to cost of goods sold, that's going to increase my cost of goods sold. So I'm going to add the underapplied overhead of $2,500 to my unadjusted cost of goods sold to get an adjusted cost of goods sold amount of $7,200. If you need to listen to that again, just rewind it and listen again. So the $72,500 is going to go straight to the income statement, and it is our cost of goods sold number. So if I take my sales of $140 from my journal entries and T accounts, subtract cost of goods sold, that's going to give me gross profit or gross margin. Gross profit and gross margin are the same thing. Then subtract my operating expenses, which in this particular case is depreciation on the admin building and other selling and administrative expenses, to come up with net income of $32,500. Okay, I'm always a big advocate of take what you know, build on it, and solve for what you don't know. So you already knew this formula. You apply it to each type of manufacturing inventory you have, and then you can get a simple income statement out of it very quickly and easily. Okay, I hope you found that helpful. See you again next time. Bye.